Hello, everybody. Welcome to today's Retirement Genius Brainstorm webinar. I'm your host, Chris Orestis, president of Retirement Genius. It's a pleasure to have you join us for today's topic, tax traps or tax opportunities in retirement, a quiz on what seniors need to know. Retirement Genius is an information and resource platform to help people achieve a well-balanced retirement. We focus on giving people financial information, health and long-term care security information, and lifestyle information. It's our belief you need to bring these three elements together to create the well-balanced retirement everybody wants and everybody deserves. So when it comes to taxes, Americans have two duties. They need to pay their fair share, but they shouldn't pay a penny more than they truly owe. Knowing how taxes work for seniors is critical to make accurate financial decisions and limit any negative impacts. No one can really create a workable budget in their retirement if they're not accounting for the impact of taxes. There's a big difference between your gross income and your net income. And that is, at the end of the day, what you have to work with. So it's important for older Americans and their families to understand as much as they can about the tax opportunities and the tax liabilities people are going to need to navigate when they're seniors. There are some differences to how taxes are treated once you've retired, once you've crossed the age of 65 and even other age points. And knowing where those thresholds are is going to be very important to understanding what you have to work with. So what do you think you know about taxes for seniors and people that are in retirement? Well, good luck passing our 10-question quiz about tax traps or tax opportunities. Don't cheat, and here we go. First, can Social Security benefits be taxed? Well, yes, this is a trap. Depending on your total income and filing status, people can owe taxes on as much as between 50% and 85% of their Social Security benefits. But bear in mind, any income that's earned up to $19,560 in 2022 would not trigger Social Security taxation. So I always encourage people to earn an income once they're in retirement, once they're on Social Security, but just know there is a threshold that once you cross, there'll be tax implications that will apply against your Social Security benefit, but that should never discourage somebody from going out and earning income and adding more to what they have to work with. Just know if you're earning a certain amount, there will be tax implications to your Social Security benefit. Is it possible for seniors to deduct what they pay in Medicare premiums from their taxes? This is a tax opportunity. Yes, if a person is self-employed, they're not eligible to receive any kind of group coverage for themselves or through a spouse, then the premiums they pay for Medicare Part B and D, Medigap coverage or Medicare Advantage plans are deductible. 3, when it comes to investment income, what are the tax advantages to being 65 or retired? Well, this can be a tax opportunity because after the age of 65, many people will retire. And this will have the impact of lowering their income, which can lower their capital gains rate from 25%, the upper capital gains rate, down to 15% or even possibly 0% capital gains, depending on their income when they're filing. Number 4, are there any opportunities with long-term care expenses? Well, yes, this is an opportunity because nursing home costs, home care, assisted living, memory care expenses, as well as any premiums that people are paying for qualified long-term care insurance policies can be deducted. Also, family caregivers can be eligible for tax deductions and tax credits based on the money they're spending out of their pocket, providing care for a loved one and the income of the person who's receiving that care. Number 5, are retirement accounts a tax opportunity, a tax trap, or could they be both? Well, they can be both because first, it's a great tax opportunity because you're putting money into retirement accounts that are going to grow tax deferred. So if you have a 401k account, any money you're putting into that account is pre-tax dollars. And I always encourage anybody who has a job with a 401k benefit to max out as much contribution as you can, because that's all pre-tax dollars. That's coming off the top of a paycheck before the government takes anything out. So you're getting the full use of the dollars you're earning. You might even get matching funds from an employer. Once money's in a 401k or money's in an IRA, they're going to grow tax deferred. But here comes the tax trap. If people withdraw money from a retirement account too young, before the age of 59 and a half, they're going to have to pay a 10% tax penalty on top of income taxes on that money. Now, the other side of that equation is if they don't take their required minimum distribution, their RMD, starting at age 72, then they're going to pay a 50% tax penalty on any shortfall of the amount they were supposed to take out that year. You have an annual required minimum distribution you're supposed to take out of your retirement account starting at age 72. And if you're taking out anything less than what you're supposed to, you've got a hefty tax penalty waiting for you. Is the sale of real estate a tax opportunity or a tax trap? Well, this can be both, because first, the opportunity is anybody who's lived in a home for at least 2 of the last 5 years prior to selling it will not have to pay taxes on the gains of up to $250,000 if they're an individual homeowner, or $500,000 if they're a homeowner as a married couple. But part of the problem is, in today's age, property values have grown so high that there can still be capital gains past these exemption numbers, and capital gains are going to be taxed at either 0%, 15%, or 20% based on the income of the homeowner. So there's a couple of strategies to reduce capital gains on real estate. One is to deduct capital improvements done to the property, significant improvements like replacing a roof, new windows, things like that. Don't confuse capital improvements with regular property maintenance. That's not going to be deductible. And for any kind of investment property, a 1031 exchange of the money from the sale of that investment property that's rolled over and put into another investment property, a similar investment property, within 180 days will avoid capital gain tax. Are tax deductions for charitable contributions an opportunity? Well, yes, this can certainly be an opportunity. It's an opportunity for a tax deduction, also an opportunity for good works. Deductions for cash contributions can be taken for up to 60% of adjusted gross income, and donations of real property, such as a vehicle or real estate or some kind of hard property, can be deducted at the fair market value of the asset. Number 8, is gifting money to family members a tax opportunity or a tax trap? Well, this is another one that can be both. Individuals can gift money to family members on an annual basis tax-free. They're reducing their estate and they're able to gift money to family members, which will be received tax-free. So as of 2022, the annual gifting limit is $16,000 to each family member. But here's another opportunity. A spouse can also gift the same amount. So you can actually double up the gifting. You can get to $32,000 a year as a couple gifting to family members. But it's important to understand that other gifts with value, and a good example is, let's say, money that's spent on a wedding or given as a gift for a down payment on a home, or being spent to help pay for tuition, that also counts towards the annual gifting amount. So the combination of cash gifts and other in-kind gifts all are recognized by the IRS as gifting within the gifting limit. So you want to be careful not to go over. Say 1 year you've gifted your total amount to the family member as cash, but then you're also paying for a wedding. Well, now you've gone over the gifting amount. Number 9, can the money from loans or a reverse mortgage be taxed? Well, this is a real opportunity because the funds received from a loan or a reverse mortgage are borrowed and they're not income, so they're not subject to taxation. And then number 10, is the sale of a life insurance policy by the owner through a life settlement a tax opportunity? And the answer is yes, it's a great opportunity. If the owner of a life insurance policy is diagnosed with chronic health conditions, that would be 2 ADLs or more, or they're diagnosed with terminal conditions, 2 years or less of remaining life expectancy, the funds received from the sale of through the life settlement of their policy can be exempt from taxation. Also, any funds that are received at or below the premiums paid into the policy is exempt from taxation. That's the basis somebody has in their life insurance policy. So whatever they've paid in premiums at or below what they've received it through a life settlement would be tax-free. So this makes the life settlement a real tax advantaged opportunity for the owner of a life insurance policy who is thinking about letting go of that policy, whether they're going to lapse it or surrender it, to potentially look at getting the full fair market value of their policy in a tax advantaged way, and then using those funds towards retirement or long-term care costs, which then can be actually an additional tax opportunity for the policy owner. So remember, knowledge is power. And when it comes to seniors and taxes, it's also the way to make sure people are being empowered to keep every penny they can so that they're able to continue thriving throughout their retirement years. But taxes are complicated. And to avoid costly mistakes, people should always consult a tax professional to help them navigate the twists and turns of all the different IRS rules, to understand the differences of tax impacts when you're retired based on age, based on income. So you want to make sure you're understanding what your deductions are. And you also want to make sure what kind of liabilities you could be either walking into or you could be avoiding based on your age, your health, and your living situation. So thank you so much for joining me today for today's Retirement Genius Brainstorm webinar. We have a free copy of a Retirement Genius tip sheet on tax traps or opportunities, what seniors need to know. So I encourage you, call 888-627-3735 to get your copy of our Retirement Genius tip sheet, 888-627-3735, and come to the Retirement Genius website for more information, retirementgenius.com. And as advisors, we invite you to come to the website we've built for advisors specifically, advisors.retirementgenius.com. Learn how to work with us, learn how to use these tools to build another revenue stream in your practice, helping families get information, access to tools and resources that they can use to build a well-balanced retirement. And don't forget, check out the Retirement Genius podcast. Wherever you get your podcasts, just look for Retirement Genius. You'll find our podcast. We've got all kinds of great episodes covering retirement and aging issues. We have great guests we've had on from AARP, AAA. Some big organizations have been joining us to talk about a variety of interesting areas and information that seniors and advisors need to know when it comes to building and living a well-balanced retirement. Remember, with Retirement Genius, we say, let's help you retire like a genius. Thank you so much for joining us today.